It was supposed to be the immaculate West Coast narrative, a changing of the guard, where Silicon Valley tech bros conquer Wall Street, print 20 times returns since inception, and crown themselves the new masters of the universe. But the market has a funny way of slaughtering the hubristic. Welcome to the spectacular, multi-billion-dollar implosion of the Situational Awareness Fund. Managed by Leopold, a wunderkind who survived the FTX collapse by the skin of his teeth, only to build an even bigger financial powder keg. This wasn't just a bad trade, it was financial suicide by leverage. Let's do the math on the sheer, unadulterated greed. The fund had a war chest inflated to a gargantuan 120 billion gross market value, all juiced up on 4 times leverage. In this fantasy land, Leopold was publicly preaching that there was a 100 times left before artificial general intelligence. Spellbound by this narrative, he went gig-along on AI infrastructure, hyperscalers, and bottleneck plays, ignoring the basic physics of market gravity. The fatal flaw in this arrogance? When you are running 4 times leverage, a mere 25% drawdown doesn't just sting, it zeroes you out. Your 120 billion gross market value drops by 30 billion, which means your actual equity vaporizes from 35 billion down to 5 billion. And at that point, the prime brokers pull the plug, because once your equity dips below zero, it's their loss, not yours. Here is the exact, hour-by-hour breakdown of how Wall Street dismantled the West Coast's golden boy. The bloodletting started quietly mid-week. The broader AI infrastructure trade began to crack, driven by weak hands who had bought at the top and were the first to panic. By early the next week, on Monday and Tuesday, the tap on the shoulder came. Prime brokers like Goldman Sachs and Bank of America quietly asked the fund to post more margin. But here's the problem. When you're holding highly illiquid garbage like Australian neo-cloud company Nebius, or a Japanese AI play called Kosha trading at 3 times earnings, you can't just hit the sell button on E-Trade. If you try to dump 10 days of volume on the public screens, you crash the stock by 50%. Wall Street smelled the weakness. In true Darwinian fashion, rival funds aggressively shorted the very stocks Leopold held in common. They stepped on his neck, trying to send liquid names like Micron to $5 just to make him cry uncle and force a liquidation. By late Friday, the rumors crystallized into a death spiral. In a closed-door, invite-only slaughterhouse, the apex predators, Jane Street, Millennium, and Citadel, were brought in to bid on the bleeding carcass of the fund. Over the weekend, it was pure desperation. The fund contacted roughly 10 parties, scrambling to place its crown jewel, a massive private stake in Anthropic. They quietly dangled 100 million blocks to test the waters, trying to mask the fact they actually needed to dump billions. Rumor has it they managed to offload half of the Anthropic stake at a 1.1 trillion equivalent market cap, but it wasn't enough to satisfy the margin gods. By Monday morning, it was a fait accompli. The prime brokers officially seized the portfolio. Goldman Sachs isn't in the business of holding toxic AI bags. Their board would rather take a guaranteed loss than hold 60 days to liquidate assets and pray. They ripped the band-aid off and executed a fire sale. Who steps in to gorge on the remains? Griffin. Citadel took over the public book at a mouth-watering discount of 20 to 50%, instantly marking the assets up by an estimated $3 to $4 billion. Griffin played the ultimate savior to the prime brokers, locking in guaranteed billions and cementing his status as the shadow central bank of Wall Street, while Leopold's fund was buried. The Situational Awareness Public Fund is dead, but the contagion is just starting. Leopold provided cover for a dozen other funds who were effectively copy trading his every move, arriving late to the party with even more leverage. When the July numbers hit, we are going to find out exactly how many other tech funds are quietly drowning in 30 to 40% drawdowns. The West Coast thought they had Wall Street figured out. In 30 days, they were deeply, brutally humbled.